Welcome to TradeTheMBI.com. This is John. This report is for the 11th of July. Well, we moved to the zero resistance point, which was from that 76 to the 100. And right when we got there, of course, what happens? Yeah, you hit a little resistance. And we saw that developing from yesterday's video. I mentioned the rise here of shorts as they were moving forward. And you can see the red actually has now slipped underneath the cyan, and really close to cyan moving above green as well. But a lot of this was baked in. We had very specific, on our intraday charts, the 5K, retrace values for positive extremes. And all we've done is revert back to the ABM yellow mid-range. So not shocking, and of course it coincides with President Trump going to Europe, which is always frightening them because they don't know what trade war announcement is going to be coming through, which is an interesting one because at the end of the day, the Europeans and the rest of them are sort of stuck because the amount of trade they do with the U.S. is far greater than the other way around, and the reality is those tariffs really hurt them, and their companies are going to be all over them. Won't take very long. And so this is one of those interesting situations where Trump is actually correct in that standpoint that he can mitigate barriers, which ironically would be a good thing for the markets in general because it would improve sales dramatically. I know that shipping anything to here to Europe with the added VAT as well as the extra duties that they charge, it's between 50 and 100% increase. And that's if you've already bought it. That's not including if you actually are a business that shipped it over. So the markups are tremendous, and it really does have an impact on whether you choose a product that's made in Europe versus one in the U.S. And so it'll be interesting to see how that dynamic plays out. You can see here a big difference in the retrace. So where we talked about the NASDAQ being ahead of the S&P and that there would be a mean reversion, you're getting it now where you're seeing it was less of a high move and a little bit deeper retrace. And that's how the market sort of recalibrates itself. You just have to wait for it, and this is what we've talked about. But if you know targets, this is why the our use of the positive extremes is so critical. We're able to see, much like we were able to see that this dip here to the low stood a much better chance of any of them of moving back. The problem you have, though, is, like I said, these falling highs are going to come down and really put your resistance points at lower levels. And in this particular case, the 50% now is getting very close to the peak of right here. There's the peak of it. So it's actually dipped below it already. So it's what was expected from before, but this was the best run the Euro's seen. Will be interesting to see what happens in the discussions. Obviously, the Brit exit turned out to be not a Brit exit at all, based on what was released. Whether or not people will stand for that, that's a different issue. It doesn't really matter. The reality is that the Fed doesn't see the need to prop up the euro at this particular point, and this is part of the Fed's unwinding of all of this money that they've thrown into the economy. The problem is that at a certain point it's going to be transferred from electronic to actual physical, and as that takes place, it's going to be an interesting one because when you're buying stocks or even companies are buying back stock, and it's not really money entering the system. It's just sort of just electronic debits. It's when people actually start pulling cash out to buy things that it really starts to have an impact. And we've started to see the first articles about significant labor shortages in that, which certainly should impact rate yields in that, as well as inflation. And TLT at that level is just a little bit out of control. This oil move, again, this is where I was getting back to capacity issues. We're seeing now first articles talking about how the U.S. will become the largest oil producer very shortly. The problem they have in the shale areas, there's not enough pipelines to handle the amount of crude they have, and so this is an infrastructure issue. That's not going to get resolved quickly. Those are bottlenecks, and that means excess reserve in that must come from other locations, which justifies added price. Not to mention the inflationary aspect of just where these prices are now are only going to fuel themselves, which usually causes a bit more of a spike. I don't think we've seen a peak in oil there, even though there's plenty of volume. We saw definitely, though, there was some crude draws, but again, that is simply because of the systematic bottlenecks that exist in America. I don't think that's going to change anytime soon. So just because you have a lot of oil doesn't mean you can do unlimited production of it. And gold still struggling, and this gets back to another interesting article on Zero Hedge. For those that are interested, something I've talked about for a while is the manipulation of gold markets and their ability to use the electronic traded paper certificates to depress actual real gold trade, which is a very interesting concept. It's no different than what was successfully done with Bitcoin. By creating the futures for Bitcoin, that's the first time we actually saw any significant declines in it. And that was back when we were up in the 16,000, 17,000 range. And it provides an opportunity to regulate using the futures markets and or index traded funds in these particular cases to really manipulate and control. Because if you're able to short the theoretical and there's some kind of balance to it, theoretically you would have to sell a certain number as well as buy on the opposite side of it. And again, the limitations, Bitcoin still holding in the 6,000 range for the near term. Simply, again, you're going to have to convert it to real money. Whereas gold is actually a physical thing that can be traded for something else. So, interesting dynamics there. Now we look at this mess. Oh my goodness. All right, this is the 5K chart. Well, we can break down what this is. We'll just go over to the left side of the chart here real quick. These were the positive strings that led to the breakout. Then we had a second series of them, and of course the last peak that was right here. And so I just started marking. Okay, well, here was the last one that was right there. Boom, hit that. Then we had another series of them that was the breakout move right here. Okay, hit that. Then there was the low second bar after the first red, right here. Boom, we filled that one in. So those have all been hit. It does leave the low for this bar here of 61. But like I've said before, the first one, not always primary importance that I look at. It's the second one, particularly if it's a significant breakout. We do have another set of ranges, but these have already been filled with the dip that was right back here. So those already got taken out, which pretty much just leaves the move towards 61 as a full retrace. But this took a few days, and this is what happens when you get the exuberance of an upside push, particularly in modest volumes. So I'm expanding the chart right now, and I'll make it easier to see what we've got developed, because they threw everyone by surprise. As we were seeing these peaks develop, it's letting you know that, hey, now I understand for a lot of people when they short, they need an immediate gratification. It's like, I've got to get my retrace right away, otherwise I'm exposed. Well, you're exposed to think of all these people who bought these longs. Every time this thing dipped here, they were buying. They got exposed to 2 bars, wiped out everything from the entire day. And even within that, we had the dip down to right about here on this bar, coming below, that pretty much filled what I had going in there, which was from the peaks, and I had shorted as we got to the high point going through, and each time we were near there, attacking that, and then we had the final 2 little dots, and we were no longer overbought from an extreme, which was kind of interesting to me in my mind, as we were getting really pretty modest shakeout readings there. And for the first time, we'd started to see some consistency with the cyan above red. And that began in the middle part of the day, right here. It had happened a little earlier. And this is always disappointing when you get this nice DOC spread. It all looks good. We got the algo indications that they're liquidating within this. And interesting, what this showed you with all of these orange spikes is how much liquidation they did going across the day here. From a short standpoint. Every time people were trying to buy into this, they were shorting throughout this entire run going through, and that was that final hurrah to get the premium average. And then look, it just took one bar to go from 100% to the zero, and then start to make new lows. And that's how fast it goes, and why markets fall 66% faster than they rise. And we knew exactly what the targets would be as they were going through. So then we produced this beautiful little white candle and they always come in right at the nice little buy configurations. It's a nice little warning. It says, hey, fine, it can give you a little pump, but that just becomes an opportunity to attack it. And sure enough, then it's just a matter of waiting for appropriate signal at that particular point. And usually I look for either the cyan crossing back above, or in this particular case, I like to look for 38 to 50%, usually are typical ranges right in there. And usually start to attack those after you've had a deep move, particularly if, well, in this case, it felt like a decent buy configuration, because again, we talk about this where you get the deep red below the extreme histogram. You make new lows on a higher extreme. Didn't have much of a difference in the shakeout, and I mean the DOC from the red standpoint, or even the shakeout made lower, so it was conversion from that point, but not from an extreme histogram, was letting us know that there was a little bit more buying activity taking place, and that's what just caused the pop. And all the pop did was get you right back to the old 23%, which now is the 38, and then it rolled back over off that. And that typically happens where you at least get at least a 50% retrace. But in this case, with the white candle, you know that you're going to come back to the close. What are you going to do? Sometimes it's easy that way. But that was some immediate action right at the end of the day to just wall up everybody who thought they could just buy with impunity. It also shows, too, the resistance that you get at some of these even numbers that really, for most practical purposes, don't mean a whole lot of anything. We just knew that without the resistance from that daily, that the push was going to be towards that 2800. And then you can see that there was just a lot of algo activity that said, nope, we want to keep shorting every time you get close to that peak. And more likely than not, they were shorting well before that point. And this was just a good opportunity to take the entire day and literally wait for a market close to pretty much trap everyone in ETFs down under low volume and collect their money. And don't know that they necessarily have completed this, because this isn't really enough bars for them to have absorbed what they did from the short side going before. So I would look for that to have a little bit more sustained downside to it. So we'll see how that plays out in the next few hours as before the market opens. Still really early in the morning, barely midnight on the West Coast. So lots of time before market open to see things gyrate, and who knows, just may depend on if there are new political comments made here in Europe. So we'll go from there. As always, though, trade well, and put up relevant charts as I did with these the other night, and started listing all these levels to be paying attention to. Trade well.